Welcome to our open lecture today. Thank you very much for your great interest in our lecture today with the topic 5 Theses on the Future of Europe by Dr. Andreas Dombret, member of the Supervisory Board of ESMT. This is actually what I'd like to start with, and obviously a member of the Executive Board of Deutsche Bundesbank. We are very delighted to welcome you here to our open lecture. As you know, these open lectures always deal with questions of current intellectual concern. And what could be more of intellectual concern than the future of Europe, where Europe is heading and what it also means in terms of regulation of financial markets, of developments on the European level. And all of this we are very fond of and excited to hear more about by Dr. Dombret. So as you know, these open lectures have been offered by ESMT for quite some time. We always invite and have the privilege of having highly renowned, sophisticated speakers to talk about, as I said, topics of current intellectual concerns. And also they give the opportunity to all those in the room to engage in discussions and to engage into questions and answers. So Dr. Dombret, as I said, we highly appreciate that you are back here for the open lecture. We've always appreciated very much the open lectures you've given at ESMT. Just for the background, Dr. Dombret was born in the United States to German parents. He actually has also a practical background in banking in a number of highly renowned high positions in international banks. He studied business management at the Westfälische Wilhelms-Universität in Münster. He received his PhD from the Friedrich-Alexander University in Erlangen-Nürnberg, and he also holds an honorary professorship from the European Business School in Österreich-Winkel. So in that sense, being at the Deutsche Bundesbank since 2010, he has a specific focus on the questions of banking supervision, financial supervision, economic education, something that obviously is also very much at the heart of what we stand for, what ESMT stands for. University of Applied Science and Technical Central Bank Corporation, something I've actually experienced as a visiting researcher at the Bundesbank to see how central banks from all over the world learn from the expertise, from the knowledge that the Bundesbank has and that it provides in collaboration with other central banks. And also, and this is, I think, also a very important part, of public discussion. Dr. Dombret is a member of the supervisory board of both the Single Supervisory Mechanism and the Basel Committee on Banking Supervision, with all the very important decisions that have been taken recently. In that sense, warm welcome to you to this open lecture. I'd like to thank our media partners, the Tagesspiegel and Harvard Business Manager. And in that sense, without any further ado, I would like to join me in very warmly welcoming Dr. Dombret to this open lecture. Thank you.
Dear Mr. Rocholl, I saw John Kornblum coming in. He may have hidden somewhere or left again. There he is. Mr. Neidhardt, Mr. Kastrop, ladies and gentlemen, thank you for inviting me back. It's a pleasure to be here. And during my last visit, I've even been in a much bigger room than this because I was moderating a meeting with Christine Lagarde, the managing director of the International Monetary Fund. So that was a very special moment, I think, both for the university here, but also for myself. So I'll talk a little bit today about the future of Europe, and I will concentrate, but not talk exclusively about the euro area. So I'll touch both on the EU and on the euro area. And I think we're then going to have a moderated discussion, but you all can be out of here around about 3 o'clock, maybe a little later, or around 3 o'clock, so that we don't take too much of your time. The notes of what I say will be on the website of both the ESMT and the Bundesbank, so no need to take too many notes. Let me start with the good news. The good news is that currently we are seeing a economic upswing in the euro area. It is kind of a fully fledged economic upswing. I'll just talk briefly about where we stand in the economy. At the end of last year, GDP has climbed by 2.4% overall in the euro area, and the outlook, I must say, is very, very positive as well. many have upgraded their growth expectations for the euro area. The European Central Bank colleagues put this for this year at around 2.3% growth. By the way, also above the trend growth in the year after that. Furthermore, apart from growth, sentiment levels are at long-term, not at all-time, but at long-term highs in the euro area. And all these indicators actually suggest that the momentum is strong in our economy in the euro area. What seems equally important is that the upswing is broadly based, much more broadly based than we have seen since a long time, meaning it now has reached many countries and many sectors, and which is a very, very important and good news. But of course, these developments don't go synchronously in each country. There are differences country by country, as countries, of course, still differ in terms of infrastructure, differ in terms of institutions, and also they differ in terms of political and economic philosophies, and for that matter, they also differ in developments, as you would expect. Apart from that, the current upswing should not distract that we are having existing issues. Those structural issues which we're facing are there, and they're going to go away just because of several years of good economic growth. Banks in several member states are still saddled with huge volumes of non-performing loans. I'll come back to that in a bit. These non-performing loans across the European Union amount to 950 billion euros, almost 1 trillion euros. And at the same time, some member states are still vulnerable due to high levels of public debt. Furthermore, indicators such as the holdings of the banks in sovereign debt show that the strong connection between a country's government and the banks domiciled in that country, this is something we call the sovereign bank Nexus, as it's known, and this has played a very important role in the euro area crisis in the last years. This sovereign bank Nexus actually continues to exist. Finally, less than a year ago, populist movements which strongly oppose the euro area and also strongly oppose the European Union were perceived as a significant threat. If I move back 1 year ago, I remember vividly that we were sitting in the Bank of International Settlement in Basel ahead of the Dutch elections, ahead of the French elections, not knowing what the outcome would be, and the political risk at that time, that's not that long ago, was rather high. Now, while their political influence, the political influence of these populist movements turned out to be rather low, the risks do remain and haven't gone away. So all in all, I would argue that there are a number of good reasons to reflect on the future of Europe, and that's why I'm grateful to the ESMT for inviting me. And I would like to use this open lecture to discuss 5 theses which I would like to put forward. First, the financial architecture in the euro area would be my first thesis, still has its weaknesses today. Even following years of recovery and after various far-reaching reforms, just think of the banking union, for example. We have seen those reforms, but there are still weaknesses. Among politicians and central bankers, this is, by the way, nothing new. It's pretty much common knowledge, so to speak. But lately, discussions on how to proceed have picked up pace again, especially coming from interventions from France and also hopes of the new German government, should it be formed, the new German government coalition, to tackle those issues. So this is again in the public domain. As far as the banking union is concerned, this debate, if you remember well, has centered around the European Deposit Insurance Scheme, EDIS, or EDIS for short, which, as you may know, should be the third and final pillar of the banking union, the first pillar being the bank supervision. I am a member of that board, supervising directly the largest banks in the euro area, the second pillar being bank resolution, and the last, still outstanding pillar to be the deposit insurance scheme, or EDIS. And I'd like to refute any suggestion that Europe is facing a standstill in discussions, because the proponents and the critics of further reforms are allegedly refusing to shift from their positions. That's not true. If we want to pave the way for a more resilient union, I don't think that wait and see is an option. We do have to move forward. Given that the financial architecture improvements are just not nice to have for the euro area, they're actually must-haves. In fact, my institution, the German Central Bank, generally backs the idea of a European deposit insurance scheme, provided, that's a typical central banker way of saying provided, all preconditions are met. But let me start by saying that we are backing this idea of this third pillar of the banking union being the European Deposit Insurance Scheme. And as far as fiscal and macroeconomic safeguards are concerned, we actually endorse several concrete reform options, such as adding surveillance of national public budgets to the powers of the European Stability Mechanism, or ESM in short, which is headed by Klaus Regling. So the point I am making, or I'm trying to make, has more to do with the sequence of reforms. When do you do what? When do you do which reform? Than whether or not to reform. We are not opposing reforms. We are saying what kind of preconditions have to be met at what time before we do those reforms. So my first thesis would be first things first. Now, I would like to illustrate my point, and if you want, please follow me, and let's take a look again at this sovereign bank nexus, because there was a reason why I introduced this in the beginning. And it is so important because it actually was at the epicenter of the euro area crisis. As we have witnessed during the crisis, the unhealthy relationship between euro area member states and their domestic banks can trigger what is known as a doom loop. With that doom loop, I mean a downward spiral which comprises banks, the government, and the entire national economy. All three things are connected. I remember quite some academic work before the crisis where we thought that the banking system is separate from the real economy and from the national economy, from the real industry. But now we very much know that there is this doom loop between governments, banks, and the national economy. Now, when thinking about making further reforms to the euro area financial architecture, I think it's really important to bear in mind what this doom loop may be caused, why it may be caused both ways. One cause is struggling banks. You had member states in the euro area where banks were rather weak. They induced their governments to come to their rescue. Think of Ireland as an example, if no reliable and credible resolution mechanism is in place for banks. All of us here in this room will recall government rescues in several countries in the euro area, by the way, Germany having been one of them. We also had the German government come to the rescue of German banks. Now, with these gloomy episodes in mind, it is entirely conceivable that in severe cases, in really severe cases, bank rescues can overburden the capacity of a certain country. We have already reached several milestones on the road towards eliminating this channel of this sovereign bank nexus. I'm referring here especially to the European resolution regime, to the European resolution mechanism, the second pillar of our banking union. At this point of the journey, the next milestone concerns realigning the European resolution framework and its national counterparts, and banks building up bail-inable capital in order to meet their MREL targets, as we call it. Once these tasks have been completed, the rules will do their part to reduce this sovereign bank nexus. But as I indicated, there is also the other direction of causality. It's not only weak banks which can cause a problem. I'm thinking of fiscally overburdened states, possibly infecting their own banking system and triggering a solvency crisis at banks. So the contagion, the negative contagion, can go from weak banks to rather healthy governments. It can go from governments with a lot of debt to rather healthy banks. It is a two-way street, actually. Now, this is more than merely a thought process to think that states which are overburdened by debt can infect their own banking system. Today, banks have large, undiversified stocks of sovereign bonds on their balance sheet. And if you look at the data, most banks hold sovereign bonds of their own sovereign. So it's undiversified, that there's a concentration risk in the sovereign bonds they're holding. That means that we actually have good reason to be concerned of that. And unlike the first contagion channel, from banks to the governments, this problem has not been dealt with from a regulatory point of view. Because I said, banks failing, we have built a resolution mechanism, but what do we do about potentially failing governments and potentially failing member states? Quite the opposite. What we have is a regulatory privilege that encourages banks to buy government bonds. At present, as you know, sovereign bonds from member states of the euro area all have a zero risk weighting under the capital requirements regime. That means that if you have a bond, a sovereign bond of any of those member states of the European Union or of the Eurozone, of course, the same thing, you would not have to hold capital against those sovereign bonds. And this means essentially that the positive economic risk attached to sovereign debt is not reflected in capital requirements. By the way, this is the only asset class where the positive risk is not affected in capital requirements. Maybe that's the reason, because finance ministers profit from low capital requirements. Nor is there any upper limit for exposures to specific sovereigns. As you well know, if you lend to a certain borrower, you do have an upper limit of how much of your equity you can lend to that borrower. But in the case of sovereign bonds, there's no upper limit, and you can basically, not only you don't need to hold any equity against it or any capital, you don't need to diversify, you can basically hold it all into one sovereign. So remedies aren't hard to find. They consist of non-zero risk weights. You could, of course, introduce a risk weight, as well as you could, of course, introduce concentration limits for sovereign exposures, as we do in each and every other asset class. Now, addressing sovereign concentration risks on the balance sheets of banks should be a top priority in further reforming the euro area financial architecture, I would argue. So in this context, let me ask you the question, how should we evaluate reform options such as the European Deposit Insurance Scheme when seeing this issue and thinking about this issue? Now, looking at potentially struggling banks and their potential negative impact on financial stability, what plays a very important role is confidence. Now, in this context, this European Deposit Insurance Scheme, is seen as an additional safety net alongside the earlier lines of defense which we are having in place, such as capital buffers and bail-inable capital. Its purpose is to maintain the confidence of the depositors in their banks and to prevent a potential bank run. I just may remind you of this famous press conference of the Chancellor and Finance Minister Steinbrück when they went out and said, die Einlagen sind sicher. So that is sort of the basic idea, which is in a more formal deposit insurance scheme, which is enshrined in a more deposit insurance scheme. Now I could spend a lot of time discussing the difficulties involved in constructing a European deposit insurance scheme of that kind. That has to be difficult. And I could reflect on existing national schemes, which we already have, of course, and which already have to fulfill Europe-wide minimum standards as we speak today. As you know, across the European Union, each account by each customer is guaranteed, into the deposits of which are guaranteed up to 100,000 euros. And the banks can go above that, but there is a harmonized amount which is being guaranteed. And here I'd like to focus at the ESMT on the connection between the European Deposit Insurance Scheme, and the sovereign bank nexus. Now, given that core structural weaknesses brought about by a sovereign bank nexus continue to exist, as I said earlier, additional safety nets are not only less effective, but may even turn out to be counterproductive, I would argue. And there are two reasons for that, which I would like to put forward. First, given that the sovereign bank nexus works in two directions, from the banks to the states and from the states to the banks, any argument about all European responsibility for deposits is off the mark. Now, how is the euro area community represented, let's say, by the likes of myself, represented by European supervisors, supposed to assume responsibility for bank failure? And how are they supposed to give access to funds if they do not have an instrument in place actually to address sovereign risk beforehand? Second, with additional safety nets in place, incentives to act prudently and incentives to act responsibly actually decline. Also, these safety nets will mark reforms for high priority issues less pressing. And this argument, by the way, is not only valid for the European Deposit Insurance Scheme, but also for reforms and for other mechanisms functioning as safety nets in order to stabilize the financial sector of the economy, like, for example, the European Stability Mechanism, the ESM. So maintaining reform pressure and reducing risks before establishing a common safety net certainly extends beyond eliminating current privileges for sovereign bonds in banking regulation. It pertains to all excessive risks currently identified in national banking systems. So please allow me to comment on one of these risk categories later in my speech, namely, as I mentioned before, the rather large amount of non-performing loans in banks in several member states. So these remarks I just made, they don't mean that I am dead set against a reform of the deposit insurance scheme. As I said before, I'm really talking about putting the reforms in the right sequence rather than doubting that we should have reform, but we say what is first. So my first point and my first thesis of those 5 theses is that if we want to improve the structural design of the euro area, we need to address, especially in a monetary union, the sovereign bank nexus, amongst other things, before we create a European deposit insurance scheme. So in other words, let's do first things first. That would be my first argument. My second proposition is this. However we seek to rectify an imperfect financial architecture, however we're going to change our financial architecture, it will not be painless. It will be actually painful. And anybody who's trying to find a way to change our financial architecture without inflicting any pain is going to fail. So there will be some pain in doing so, like it or not. Overhauling the less than ideal statics of a financial construction, by the way, is not a simple task. It won't happen, by the way, soon, and it will very, very likely involve stress. But there is no easy alternative to it either, despite the fact that we're talking about pain and that we're talking about stress. This can be seen if you take a look at discussions surrounding what are known as sovereign bond-backed securities, or SBs for short, SBBS, sovereign bond-backed securities. There is no question that this financial instrument is interesting from an academic point of view. So by all means, I would like to bring it up at the European School for Management and Technology. But are these instruments, these SBs, interesting as a policy option, given the weakness of our current financial architecture, is a question I would like to quickly touch upon today. So some people who are arguing in favor of SBs have actually argued that they could serve as a helpful financing tool. For example, because they could automatically diversify sovereign risk. These SBs do pool sovereign bonds of certain member states, and at the same time supposedly involve no collective risk whatsoever for the European community, even in times of financial stress. I must say, I'm not convinced, however. In order for SBs to function properly, quite a number of factors have to be considered and have to be looked at. For example, collective risks which might emerge due to a bridge financing, a collective risk which might emerge also from guarantees, need to be precluded. And I won't go into all those constructual details of these SBs. I would like to straight away jump into the key argument of the people who propose those SBs. And I would like to look at the sovereign bank nexus. SBs will not function without the aforementioned reforms of sovereign exposures in the regulatory rule for banks. So this is actually a necessary precondition for this to work. Now, given the current privileges of sovereign bonds in capital requirements, as I said, of banks, they have strong incentives to buy these bonds directly. They buy the German bonds, the French Trésor, they buy them directly. For SBs, there would actually be no regulatory privilege, like in the Bunds or Trésors or the, Italian instruments, whatever they are called. And I would argue that if you do not have a privilege in the capital you need to hold against the SBs, the likelihood of these SBs to be a big market success will be very low, because you can buy sovereign bonds directly and profit from the fact that you don't need to hold equity against it. Now, some have called for a comparable privilege for SBs too. Yeah, then of course that would work. But this is no option either, I would argue, if we want regulation to be risk adequate. And we do want regulation to be risk adequate, which means it needs to take into account the non-zero risks of government defaults. This has to pertain to any financing instrument for sovereigns, which then of course would include SBs. Otherwise, we would have merely relocated financial stability risks, let's say from the German Bund or from the French Trésor into an SB. We wouldn't have changed anything. And these securities then do not offer any easy way out. Sometimes it seems that all that representatives from German institutions, I would maybe even say that all what representatives of German authorities have to say about Europe is that it needs to adhere to a strong set of rules. Many other countries say Germans are only talking about rules. And of course that these rules need to ensure that those who are in control of risk and opportunities also bear the consequences. So I have this very often. Other countries understand different things under rules than Germans, and Germans only insist on rules. And I would like to say two things about that. To start out with, I am a strong proponent of this idea. As abstract as they may sound in a speech, a lot of empirical evidence and day-to-day wisdom went into those rules, I must say. They just didn't come around easy going. The second is Europe's future does indeed require more than a well-balanced architecture. And I would like in the following to concentrate on those other fields. And first and foremost, I think we have to rigorously target the risks we already know. We have to target the risks we are already aware of. That is the most logical thing to start out with. And those who are familiar with the priorities of the European Bank Supervisory Mechanism, the SSM, will know that I will now start talking about non-performing loans, because we know about this risk of non-performing loans. We know at the latest since the asset quality review, which was done in 2014, where we looked through the balance sheets of all the directly involved banks very, very closely. So my point here is this. The European supervisor should not hesitate to vigorously pursue this issue and to address it as soon as possible, because we are aware of that risk, and it's very large and very, very, very significant. Not only because it remains a threat to the stability of the banking system in the euro area, even though capital cushions have improved at banks across the common currency area. Not only we should focus on it because we need to address these legacy risks before moving on with reforms that incorporate risk sharing across the euro area, but importantly, we should focus on that because NPLs actually impede the recovery of individual banks, and they also impede national economies, because there's lots of empiric work that if you have non-performing loans on your balance sheet, you will be hesitant to lend. And if you're hesitant to lend, you are, of course, having an impact on the economic development of your economy. So NPLs consume, by the way, a lot of time and attention in banks, in credit institutions. And we have experienced that banks which are preoccupied with large amounts of non-performing loans are very hesitant, as I said, to do new business and to lend out new business while they still have to work out their non-performing loans. And this creates bad long-term prospects, not only for these individual banks which have these non-performing loans, but also for regional economic recovery, which then is likely to be slowed down significantly. And against this backdrop, I also acknowledge the considerable progress made by individual banks in our monetary union in cleaning up their balance sheets last year, not only because mounting supervisory pressure, mounting pressure by the single supervisory mechanism forced them to do so. They actually did try to clean up quite large parts of their non-performing loans, so they have to be congratulated and applauded for that. But also because the improvement of asset quality creates this long-term value for their stakeholders, it was wise to do so, and whoever can do so needs to do so. In that vein, let's not dwell on supposed European conflicts of interest surrounding the treatment of NPLs. I propose that we see this as a conflict between short-term and long-term regional interests. And therefore, I strongly support the take of the European supervisors on non-performing loans. I think we're doing the right thing. So my fourth thesis is resilience is not a state, resilience is a process. You're never there. You always will have to be in process. And to make this point, there's no better example than cyber risks, which is a considerable risk also for banks. And here at the ESMT, where the T stands for technology, I don't probably have to convince anybody that technology matters. If you want to get a full picture of where the economic and financial systems are headed, you have to take a very close look at IT topics, and you have to take a close look at IT solutions, even if you're not studying or visiting the ESMT. Now, from the viewpoint of a banking supervisor like myself, even though a lot of our daily work is centered around capital requirements, capital requirements, some have called capital requirements the magic bullet of banking regulation, which is maybe true, maybe not, but cyber risk and other IT-related risks are quite special. For even in adequately capitalized banks, which have no problem with their capital, which have no problem with their equity, we have no problems meeting all the regulatory standards and supervisory standards. This doesn't prevent them from IT-related financial stability issues. You can be the best bank in the world, and you're not safe from IT-related financial stability issues from occurring to you, such as downtimes in payment systems or massive manipulations of financial ownership, etc., etc. So even if we regulate and supervise a bank in the most perfect way, there's still the threat of cyber security, of course, or cyber risk to even the best financial bank, which may be behaving in the most perfect way vis-à-vis the society and also vis-à-vis, let's say, the regulatory environment. And therefore, financial supervisors need to target those risks in a direct way, pushing the financial sector to make incidents less likely and emergency responses as effective as possible. We cannot prevent incidents, but we can make sure that everybody understands those risks and is prepared as much as possible. So if there is an incident, that there is as little impact as possible. So what is the European dimension here in this cyber area? Well, I think it's all too easy. In cyberspace, there are actually no borders. Hence the ease with which cyber risks transgress national boundaries. We have to be sure to target all those weak links. Now this especially refers to infrastructure prone to cyber attacks. And in banks, a lot of the infrastructure actually is prone to cyber attacks. Europe has acted already. although this has been largely unnoticed by the public. We have a directive on security of network and information systems. It's called the Nis Directive, which was adopted by the European Parliament in the middle of 2016, so which is now 1.5 years old. And this actually obliges member states to be adequately equipped and to establish minimum standards for important infrastructure. And of course, the banking sector is an important infrastructure. It also fosters cooperation among member states in cybersecurity measures. And there's nothing more important than cooperation. I can actually say that this European stimulus has even reached the realm of national banking supervision, where I work. We are currently working on aligning various supervisory standards with the requirements of a critical infrastructure, and we are putting a lot of work, also the colleagues from BaFin are putting a lot of work in this in order to make sure that we not only understand the issue, that we also connect the dots. Also, Europe offers opportunities to join forces in combating cybercrime, because mutual learning is very, very important, but you need a space where you can discreetly tell about cyber attacks which you have seen without them being used against you in a competitive way. And as attack methods in the cyberspace constantly evolve, and given that there's no once and for all cure for cyber threats, the best response I think we can give is we need to evolve as well. And we have to try to evolve somewhat in parallel with the evolution in that area. So as I said, mutual learning is generally a very good thing, but in a digital environment, it is hugely important because we cannot build on a long history of best practices. So we have to learn from each other. We have to learn from the attacks on others in order to see what could be coming our way. And it is a setting, as we know, the cyberspace is a setting where small mistakes can be extremely costly. Whereas, let's say, a small mistake in the regulatory environment is not going to be extremely costly. It can well be in the digital infrastructure. And I'm happy to say that for bank supervisors, interaction with colleagues from other countries is already a part of our day-to-day business also in that digital and cyberspace area. That was my fourth thesis. And so far, I must say, and I must apologize, because I have presented you with 4 rather bureaucratic propositions. That is not unusual because we work in this bureaucratic area. But is the question I asked me when I was writing down the thesis is this really all there is to Europe's future? Bureaucratic answers? Are we going to build a future in Europe if we stay bureaucratic, as important as bureaucracy is? Does all I have to offer is a bunch of good recipes developed by experts? And then you must wonder whether we're going to be really solving European issues. Technocrats, I think, will have to concede that while we may alter rules and while we may change incentives and while we may be doing good things, this would actually not resolve discussions about Europe altogether. We have witnessed a surge in nationalism, as I said before, and populism in several member states. I don't think with our good technocratic and bureaucratic rules we're going to solve those issues. And since the Brexit referendum, we know full well that criticism and doubts about the European project, however well-founded these arguments may have been in the Brexit referendum, won't just come and go ever so often. So we have to also think a little bit beyond bureaucracy and technocratic aspects. Now, I'm well aware that perception about Europe very, very often is complex and is of multifaceted nature, and I will not run into an in-depth analysis what is Europe for whom and what we can do. But there is one issue which most perceptions about Europe share, and which I'm actually quite familiar with, so I'm putting it into my fifth thesis, because we happen to encounter it in our own education work at the Bundesbank, and as Professor Rocholl just said, I'm heading the education work at the Bundesbank. The fact I'm talking about is the sheer complexity and the high level of abstraction of European economic matters. So you may be understanding most of that, but many people don't have a clue what I'm talking about, not the faintest idea what I'm talking about. In discussions on Europe, economic topics such as the financial crisis or the euro area crisis actually play an important role, and for the general public these matters are not at all easy to understand, despite the fact how many courses the ESMT may offer on this. In fact, you yourself can only grasp the speech because you are coming as a well-informed audience and you have studied these issues before. Otherwise, it would also be quite difficult for you to understand what is an ESM and what is an SB, etc., etc. So at the Bundesbank, we are ourselves engaged in economic education. After all, monetary policy reasoning can only be successfully communicated if the general public has a basic understanding of terms such as inflation or interest. It's going to be very difficult to tell them what we are doing if they don't even understand what inflation and interest rates are. There is a high correlation between the ones who support you and the ones who understand you, as you would expect. So one major takeaway from our work, be it in schools or at educational events offered to the general public, is nothing happens by itself. You have to also help a little bit. We need to foster an understanding of the economic and financial topics in Europe and of the euro area. If we don't do that, we will be in our little world talking amongst us and nobody will understand what we are actually talking about. At times when populists come up with supposedly simple solutions and simple answers, this is becoming even more important, I think, that people understand, because again, support only comes if there is an understanding of the issues. And my point concerns not just economic education, it goes for political education probably as well. It is the task of political education to adequately communicate European ideas and to adequately communicate European values, especially to the younger generation. It is about highlighting the advantages of European cooperation. It is about providing citizens like yourselves with the tools they need to understand and the tools they need to classify issues around Europe. So this would be my fifth and last thesis. We need to work on a better understanding of all the issues we are talking about. Thank you very much.
So thank you very much for these very insightful remarks. You very convincingly laid out elements of the financial architecture in Europe. You called them bureaucratic, but potentially also architecture elsewhere or construction of buildings might be bureaucratic in itself. So therefore, this might not be too surprising. I'd like to point out, or like to lead the discussion into a couple of points that may actually be on top of what might be needed for this financial architecture. And one aspect you mentioned already is Brexit. So the question of how is the future relationship in financial markets to Britain. And in particular, we've seen approaches, probably not so much from Germany, but from other countries in, say, poaching institutions to come, potentially to come to Germany. On the other hand, arguments about the spillover, the negative spillover effects of not having a strong financial center in London that could also have externalities on the rest of Europe. So what is your view in terms of Brexit for the financial architecture?
Yeah, that's a very difficult question. Let me start by saying that over the last decades, we have gotten used to this very close relationship with Great Britain, of course, also in the financial sector. If you live in one single rule book and you live under the same rules and sets, of course, you get to know each other very well, and and it was taken a little bit for granted. Nobody really thought about that this would be special. Now people realize it may have been very special, because the largest financial center by a big margin is leaving our EU 27 financial sector. What worries me a little bit is the fact that we don't know very much at all about what the financial architecture of Great Britain wants to be after March 2019. All statements up to now have been very vague. I know John Kornblum is a former diplomat, so I'm going to be a little bit less diplomatic, but I fail to see the progress in the negotiation. I remember when the Chancellor of the Exchequer came to the Baden-Baden G20 meeting, and when I heard him in Berlin recently, he was still saying the same thing. So I'm not quite sure what happened in the British position, and that is not good for us, because we want them to come and present us a position where they want to be. I heard the Chancellor of the Exchequer say, we are not Canada, we are not Norway, we are not Switzerland, but he actually didn't say what exactly Great Britain wants to be in terms of its financial sector. And before we know that, how can we figure out what the relationship will possibly be? So we are in a divorce situation where, Great Britain divorcing from the EU, where we have no idea how we are solving very basic questions like the Northern Irish border situation. We are miles away from discussing issues of the financial sector in the future. So we are still, although we have moved in December to phase 2 of the negotiations, we're not that much into phase 2 of the negotiations, because the British government is apparently finding it hard, and I'm not saying this without any schadenfreude at all, they're apparently finding it hard to figure out the political stance they want to take vis-à-vis the EU 27. So your guess is my guess, I could say, because we don't know what they want to be. Now, the Prime Minister recently has said that maybe Great Britain wants to evolve away from the European financial sector. And that sort of concerns me, because what we don't want is a national deregulation somewhere. As I said and tried to say before, we are in a global world, and banking is no longer national but international, and if one country starts to deregulate and tries to have an advantage from less regulation, for example, that is going to inflict on all of us. It's not going to be an isolated effect staying on the island, so I hope that's not what she means. So that would not be good. We need to work together to fight those vulnerabilities, cybercrime being the most logical one, where there are no borders, of course. Yeah? And if we start to have different rules in different countries and try and open the doors for regulatory arbitrage, that would be a matter of concern. Especially if it would be Great Britain for us in the EU 27. Yeah? Because it's so close and we are so interlinked for decades, economically and also in terms of the financial sector. So this long answer tells you that I actually have no idea where the British financial sector will actually evolve and where the government wants to evolve the British financial sector. And that is why I am simply not able to give you a reasonable answer to your question, although I spoke for quite some length.
That is also obviously a very interesting answer. Another aspect that has become subject of much discussion also here in Germany, or maybe in particular here in Germany, is the question of proportionality, the principle of proportionality, the question of how is the regulatory environment treating small banks in particular. And you've mentioned before the need for capital and liquidity standards to be strict, to be applied to all institutions. At the same time, you also mentioned in previous speeches the possibility to rethink, for example, some of the bureaucratic requirements that are affecting smaller banks. What is the view there, and what is maybe also the idea of how to deal with this aspect?
Yeah, thank you for that question, because that's close to our heart. Let's think through where we are before we try to give any policy answers. Now, we are in Germany in a banking sector where we still have somewhat more than 1,700 banks. So we have a diversity of banks in terms of size, and we have also a diversity of banks in terms of business models. I actually believe that's good for the German banking sector, because it actually strengthens the solidity of the banking sector. If you would have to draw up a banking sector on a piece of paper, having resilience in mind, not necessarily profitability, but resilience, a banking sector with lots of buffers because it's diverse is probably somewhat more resilient than one which has 2 or 3 banks. So if you would have a blank sheet of paper, resilience always goes with diversity, profitability goes with a small number of banks. Now, if you are responsible for bank supervision in Germany, it does not take Einstein to figure out that you need to think through that we are very different from the rest of Europe, because the rest of Europe, with the exception of Austria, maybe the exception of Italy, don't have these fragmented banking systems, but have more concentrated banking systems. So the second step you have to then make is that, actually the rules and regulations have become so complex and so complicated, and because banking has become also so complicated and risks are so large, and these rules and regulations were written for the large international risky banks. And if you are a bank with a balance sheet, let's say, of 1 billion euros, and you are somewhere in the region with very limited risk, you still have to adhere to all of these bank regulations. So we have banks, lots of banks, more than 1,000 banks, who sent in to Mr. Neidhardt, who's the chief bank supervisor in Berlin, who fill out the forms and just putting blanks. And we had Mr. Neidhardt had then people in his team checking whether there was a blank. That is not very effective. We have to be, as I said in my little speech, you have to supervise in a risk-adequate way. You have to go after the risk, not the completeness is maybe less important than going after the risk and prioritizing the risk. That's what you need to do. So that's why it's my strong belief that whilst we need the same liquidity rules and the same capital requirements for everybody, the complexity of this administrative burden of all these rules on everybody needs to be proportionate. And if you have less risk, you also, maybe you don't need to send in the same amount of data each month, which a very large bank has to send in. Maybe we can have a good feeling of the risk by only receiving this data in a somewhat less often fashion and still have a good idea. If you look at the German banking sector, just to give you an example, and if you take all banks up to a balance sheet of 3 billion euros, this is 82% of all banks in Germany have a balance sheet of less than 2 billion euros. And if you add all balance sheets up, those banks have a total balance sheet, aggregate balance sheet of 14% of all balance sheets. So 82% of the banks in number have 14% of the aggregate balance sheet. And if you say, especially with the smaller ones, the balance sheet is an indicator for the risk, so if you do a somewhat lesser strict requirement on administrative burdens on those 82% of the banks, you can concentrate on the 18% and you catch 82% of the risk. So, or 86% of the risk. So what I'm trying to say is we need to be proportionate. Not a small bank with very low risk should have the same frequency, the same amount of data put forward, because the additional added value is too small Whereas large banks, especially those internationally active banks, these globally active banks, very much engaged in derivative and other more risky activities, need close supervision because that's more risk adequate. And that is the best way to preserve our banking system, which has, by the way, served us well in the last financial crisis because of its diversity, because, by the way, the German banking system had its fair share of problems, I must say, but still was able to work it out, which is, at the end, the ultimate task also for the taxpayer.
Thank you. So now we have a little bit of time for questions from the audience. So if you could briefly, first of all, wait for the microphone. I think there's one remark. If you could, and briefly identify yourself and then obviously ask the question.
Hi, I'm Abhinav, and I'm a student of MBA 2018. So I have two short questions. So one is with regards to, so the monetary policy does its bit, but the debt to the GDP ratio across the Eurozone is going up, and the government spending is increasing or it's constant. And right now, there's an upswing in the business cycle, but when the downturn comes further down the line, then how do you see that panning out, and what steps can be taken to address that problem? And second, a quick question is, you mentioned about the strong growth projections for the forthcoming financial year. The interest rates across the Eurozone are low, and the inflationary pressures are bound to rise. And the wage increases are not going to be that substantial. Employment rate is going to go high. So what can the monetary policy do to address that? Thank you.
Okay, that was... You'll do very good in your exam, I must say. Given the complexity of your question, I should have taken notes. Now, the first question was... the second question I remember, so I'll start with that. The first one was debt to GDP level. The second question was actually about growth prospects, wages not growing, and how that will, inflation on the rise, as you said. I wish you were right, and what that means for monetary policy. As a central banker, you look at your mandate, which is price stability. And clearly, we are not yet, right now, at this level of what we define as price stability. Nevertheless, what is very often not seen is that this is a in the medium-term target, not one which you have to fulfill all the time, and that you're looking very much at inflation expectations. And the inflation expectation is one that we will meet our price stability target at the end of the projection horizon. And whatever you look at is confirming this. So you are right that wages are not climbing. When you speak to the unions in this country, for example, they will tell you in a country with such a high employment as we are having right now, they are more focused on skilled learning, flexibility in the workforce, all of which will drive up the cost for the company, but which is not necessarily going to be shown in the inflation number. So I think you have to look deeper, and an economic upswing as we are having is not necessarily automatically transferring into inflationary pressure, but the monetary policy stance we are having, I would defend as adequate, but the outlook for it will call for a change in monetary policy when the time is right. The first question was about debt to GDP levels, and I don't really know the debt to GDP level in Europe, but I can tell you, Herr Kastrup, are they rising, debt to GDP levels in Europe?
Right now, not.
That's what I thought too. In Germany, for sure, they are not rising, but they're not really rising that much, but they're still rather high. That I agree with, yeah. But it's not really rising, so I'm not so sure about that part of your question. But you have to look always also at the demographic factor. This is at least what I'm doing, especially in the context of Germany. If you look forward and see that from the year 2020 onwards, we will sort of have less people in the workforce, your trend growth will go down. There are estimates out there that our trend growth right now is somewhere around 1.25% in Germany and may well go to 0.7% in 2030, although you always have to be very careful with projections which are that long into the future. Nevertheless, it will go down, which will mean that then the debt will be have to be calculated over a lot less people than right now. And that's why it is important that you contain your debt to GDP level, always having in mind that we still have a Maastricht criteria of 60%. If we, Germany, that is at least my opinion, as the anchor economy of the European Union, don't strive to get towards the 60% Maastricht criteria, who else should do so? But we are on the way, and we have to, then we have maybe a little bit more leeway to think about that. But debt to GDP is not an issue in itself, but it has a value which needs to be preserved.
Yeah, Christian Kastrop, now at Bertelsmann Foundation, head of the European department. Very simple question. You talk a lot about, say, important, necessary regulation, how to do it. What about the risk of proactive over-regulation of that?
When an economist asks you, says a very simple question, you have to be very careful because these are the most difficult ones. Let's talk about this in the context of bank regulation. I think that was your question. I believe that very inefficient or inefficient banking markets in itself may cause a financial stability risk. So you have to try to find an equilibrium between the sort of regulation in order to make sure that the risks are contained and the efficiency. As an economist, I also very much believe that each and every regulation needs justification because you are impacting in the market economy, and just because, for example, last week I was in London. I've been asked 5 times on TV whether or not we should regulate the flash crash. And I said, it's incredible. You know, everybody wants regulation straight away. Wouldn't you like to think about it first before you regulate? So, you know, there may well be an overburden of regulation at some point. And then markets become inefficient. They are no longer markets. And then you may wonder, you know, what you are creating. So I agree with your indirect question.
Herr Dombret, my name is Wolfgang Klomp. I'm with a liberal think tank in Paris. That's why my question will concern France, if you don't mind.
The last name like mine?
Everybody is talking about government, public debt. Quite a few people are talking about private debt. That is debt of private houses and companies. Figures and data have been released recently. And according to these figures, France is running ahead all major European countries with a private debt nearly twice as high as government debt, the public debt, which already does amount to 100% of GDP. Now, and the big problem is the bulk of the private debt is financed by variable interest rates. Now imagine that the European Central Bank is supposed to raise sooner or later interest rates. It cannot dare that without putting on stake the financial stability and the stability of the banking system in France and putting on stake the economic recovery. So my question, and that will happen in France, which is supposed to save Europe. So my question is my concern justified or not at all?
First of all, I see your point. By the way, it's not only a French issue. You have also other countries and member states which have become accustomed to very low interest rate levels and are living in, also, if you look at the German budget, we are also profiting from the fact that the German government is paying very little for its debt and is having, of course, a big advantage from that. If you would not have that benefit, our budget would not be positive. It would be rather in the red. So also we are profiting from this very low interest rate level, and other countries who have more debt, even more so in relation to us. Now, so it's not only a French issue, but let's talk about this French case. As a central bank, you only have a mandate with regard to price stability. And that is what you need to watch at. My concern is that because of the QE program, the ECB is now the creditor, the largest creditor in each and every member state by a big margin. And that incentivizes those member states represented by their governments to put pressure on the ECB not to do the right thing. I'm trying to be as unpolitical as possible, not to do the right thing and react in terms of monetary policy when the time is right. So there is, and that is when you get to a position where fiscal policy and monetary policy gets blurred. And that is a big concern. So the Bundesbank, that I can promise you, will ask for monetary policy action when the time is right. Is the time right now? Correct? No. We still are away from our price stability target. We have to fulfill certain others, but expectations are brightening up. So you have to be, how to say, independent of your governments in your decision. That reminds me a little bit of my previous comment to Mr. Kastrop on regulation. When I was asked, why don't you regulate straight away? It is not the function of regulators to prevent stock market participants from losses, to be very blunt. And it's not I don't want anybody to lose money, but stock markets may well go up and down. And it's not the job of monetary policy to prevent somebody who has borrowed in a variable rate rather than a fixed rate, or the other way around, whichever. It is a very clear, independent mandate. And I am confident that the ECB will do that, because the ECB is a very, very important body and in Europe, and we need to preserve the independence of the ECB.
Thank you. So now, if we want to keep actually our promise of having you out by 3:15, maybe let's give the last question to John Kornblum.
Thank you. I'm John Kornblum. I'm also, like Andreas, an American who lives in Berlin. And I noticed very often now, Andreas, with your great speech, which you always do, one of the words you used very often was preserve. And that's the word you hear continuously now in Europe. Preserve the banking system, preserve the liberal Weltordnung, preserve our regulations on Datenschutz.
Sometimes I said maintain. I think that's almost this.
Et cetera, et cetera. And at the same time, I did not tell you, you know better than I do, that the world around you is changing faster than we can even define it. The top 10 companies in the world now have no assets, basically. They just take money from one place and put it in another through manipulating digital systems, etc., like Facebook and like Google. They have very few assets compared. Google has 30,000 employees about. The Ford Motor Company has 250,000 employees. Daimler has probably also 300,000 employees. In other words, we're coming into a system in which much of what you talked about may not any longer be relevant. And so the real question, it seems to me, is not whether you're going to be able to hold the finger in the dike for the next 5 years, but what is coming next. Germany may no longer have an important international bank, for example. The proponents of blockchain tell us we don't even need banks anymore in another 10 years. So what is, I'm sure down in the basement of the Bundesbank someplace you have some brilliant people who are thinking up the next chapter of history. How do you think this current financial system is going to fare against the really heavy hurricane winds which are coming up against it?
Okay, that's. I'll give it a try, but we only have like 2 hours to.
2 minutes, please.
Yeah. Now, banking is about confidence and trust, and whether it's capital markets, whether it's lending, depositing, etc., it's all about trust. And for trust, you normally need a system in which you can operate. You cannot do this. Trust doesn't evolve because you meet somebody on the street, and so you need a framework, an institutional framework, if you accept that wording, in order to get there. The trust, despite the fact that digital currencies are, if there are currencies, which I doubt, digital tokens are growing, etc., the trust is still with the banks. And it depends on whether the banks can maintain or preserve that trust. If they can, they will have a big future. If they don't, they're going to be called into question. So, whilst things are evolving, and you're right with all your statements, it all comes down to the element of trust. That is very much seen in these cryptocurrency issues, where some people like to buy bitcoins or other so-called cryptocurrencies. There is no investment, there's no central bank involved. There is you don't know with whom you're dealing, etc., etc. You don't even know the algorithm you are buying. You have no idea. But this is still only a very small amount. It is growing, but it's a very small amount. It's fluctuating. It doesn't have an institutional framework. And this is why, in my little speech today, I try to set a couple of theses how we can make our institutional framework better. Because if you lose the trust, you're going to turn away to populist, to all sorts of nationalist issues. If your bank gets robbed by cybercrime, you may well lose your trust in the banking system, etc., etc. And that's why the gentleman from Paris is so right that France plays an important role, because if France and Germany work together, we can sort of reform the euro area and have a better institutional framework that we can see that the trust is well invested in this institutional framework. But I also said you need to evolve permanently, because things are evolving around us. So you have to make sure that you keep trace. And that's why I made this last fifth thesis about education and mutual learning, because if you don't do that, and here we come back to the ESMT, if you don't do that, you have a problem. So thank you very much from my side, and happy Valentine's Day.
Yeah, thank you very much from our side. Thank you very much for the time, the insights you provided to us. We look very much forward to welcome you soon back for another open lecture. And we take it as our mandate to keep education on economics and also political economy as an important part of our mission. Thank you very much for your interest, and have a good afternoon.
Thank you.